Hi, Assalamualaikum. My name is Siti Aisyah binti Muhammad Rizwan. So, I will present about the background of the company. Firstly, we will start with the company of Pensonic. Pensonic Holdings Berhad, founded by Dr. Chu Wenkat, is a company that started business as a small shop in Penang selling electrical appliance trading under the name of Kit Radio Company in 1965 as a sole proprietor. In 1982, Chu started the Pensonic brand name to produce locally manufactured electrical appliances in order to ensure long-term growth of his company. And the brand name Pensonic was invented by combining pen and sonic to mean the sound of Penang. In addition, in 1982, the Pensonic Group began importing and assembling the first batch of audio and visual products under the Pensonic brand. Pensonic was registered as a trademark in Malaysia in 1984 and is now registered in more than 20 countries, thus laying the foundation for global expansion. In 1988, the Pensonic Group commenced manufacturing and marketing of electrical home appliances under the Pensonic brand. Then, we move to the company of Toshiba. Toshiba is a Japanese multinational conglomerate headquartered in Minato, Tokyo since 1875. The company name was officially changed to Toshiba Corporation in 1978. In 1981, Toshiba Tech Malaysia Manufacturing was established as a subsidiary of Toshiba Tech Corporation, specializing in telecommunication equipment. Toshiba Tech Malaysia Sdn Berhad is one of the trusted leading systems and solutions providers in Malaysia with operations across Malaysia and Thailand. They bring forth an array of seamless printing solutions and document management to engage end users with more cohesive and efficient experience. Since their establishment in 1981, they have held themselves accountable to all their stakeholders by honoring their commitments, providing effective solutions, and aiming for the highest quality service. Next, about the current issues or current development of company. For Pensonic, there are two current issues. First issue is Holdings Berhad informed that a fire incident had occurred at its office Chum Service Centre belonging to its subsidiary. Pensonic says and Service Sdn Berhad in Petaling Jaya on Monday 21st June 2021. Besides that, another issue is Pensonic auditors issue qualified opinion on FY20 accounts. The external auditors for Pensonic Holdings Berhad have issued a qualified opinion on the group's financial statement for the year end May 31, 2020, FY20 due to the non-impairment of receivables. Why? For the current development, even though their product development has been delayed by the pandemic, they have managed to add a few more devices such as smart door locks and cameras to the Touch series. Other devices under current development included plug tops, IR controllers, and on-off switch, which will be available by the year end. They are working hard on expanding the product line to include bigger home appliances such as ceiling fans, washer dryers, portable air conditioning, water dispensers, and cookers. The Touch smart home appliance, with its energy saving and digital convenience features, fit well in an increasingly digitized world and smart homes. There are three current developments of Toshiba. First and foremost, for students, it is important to review lessons and lectures efficiently, and especially to pinpoint just where the teacher or lecturer said what. Therefore, with 2SC Live TM, Toshiba has developed a powerful tool that brings benefit to both teachers and students. 2SC Live TN is an automatic subtitling system for online classes that delivers a real-time record of what the teacher is saying, and students can view them on PCs, tablets, and smartphones. Besides that, Toshiba has developed two kinds of isolation integrated circuits for realizing next-generation powered electronic systems that are compact, energy-saving, and highly reliable. The first development is the bidirectional multiplex transmission IC, which isolates driver circuits of power semiconductor devices. Another second development is a high-speed isolated measurement IC that can be installed in power supply system for servers in data centers that require high-speed operation. That's all from me.
Hi, Assalamualaikum. So now I will proceed with the common size balance sheet. It is referred to percentage analysis of balance sheets. The items is presented as percentage, so it is easy to compare. Here is the balance sheets for 5 years of Pensonic company, starting from 2016 till 2020. The line item is fixed to total asset as the denominator. As we can see, Pensonic's cash is increased about 2%, which equivalent to 400,000 ringgit increases from 2019 to 2020. This means that Pensonic has better liquidity in terms of cash, the most liquid asset. For the total account receivable in 2020 is considered as decreasing, where the most of account receivable have paid their debt and contributes to the cash amount of the company. With the significant decrease of inventories, finished goods and raw materials in year 2020, it makes the total current asset for 2020 is the lowest compared to the others. So for the next is the fixed asset. For the net property, plant and equipment, the highest percentage is in year 2020. Company had increased their asset in terms of building with the amount of 33.98%, increase from 23.1% in 2019. This contributes to total fixed asset in year 2020, where in that year is the highest total fixed asset compared to the others. With the lowest percentage of machinery in 2020, it contributes to lower accumulated depreciation of the company in that year. So the next is the liabilities and shareholders' equity. All the line items calculated based on total liabilities and total equity as the denominator. So regarding to the table, Pensonic's percentage on short-term debt has fluctuated from 2016 till 2020, but in 2020 it gives impressive result when it is the lowest percentage throughout the year. The account payable for Pensonic also fluctuate, resulting to end of 10.09% of the total liabilities for the year 2020. Besides, the long-term debt has significantly increased in year 2020 compared to years before, which double amount of the previous years. Lastly, the retained earning has increased from 2018 to 2020, which is 14.72%, but the amount is still lower than 2017. Now, we know that the amount of yearly profit retained in Pensonic is considered as high for the latest year, 2020, compared to years before. Okay, so now we will compare the Pensonic to another company, Toshiba. Toshiba has higher liquidity compared to Pensonic, where it has higher percentage on the cash and account receivable. However, even though Pensonic has lower percentage on the cash and the receivables, Pensonic has quite high percentage on for the inventories, finished goods and raw materials. Pensonic could gain the profit for the company by selling the finished goods and process the raw materials. Besides, the total current asset for Toshiba is higher than Pensonic. One can conclude that Toshiba has better ability to pay debt obligation faster in terms of cash. For non-current asset, Pensonic has higher percentage compared to Toshiba, where contributed from the net property, plant and equipment. It is impressive for Pensonic when they has lower accumulated depreciation as they invest on the assets such as building and little machinery. So the fixed asset value would increase from time to time. Hence, it is good for the future value. As Toshiba has higher percentage on the machinery, it quite bringing up the percentage for the depreciation. Lastly, the liabilities and equity. So we can see Pensonic has higher percentage on the short-term debt and long-term debt. But however, the total liabilities of Toshiba is higher at last. We can see it was contributed from the account payable and other current liabilities. So the total equity for Pensonic is higher than Toshiba, but the retained earning for Toshiba is double amount of Pensonic's retained earning. So we know that the amount of yearly profit retained in Toshiba is higher than Pensonic. As a conclusion, for the common size balance sheets, we can see that Toshiba give higher retained earnings and using lower debt in the operation compared to Pensonic. That's all from me. So now we move to the next presenter.
Assalamualaikum and hi, my name is Anissa Akilah binti Zainal Abidin. Okay, I will continue to the common size income statement. The common size income statement is an income statement in which each line item is expressed as a percentage of the value of revenue or sales. Actually, a common size income statement was convenient to see what's driving a company's profits. Besides, it helps to show how each line item or components affects the financial position of the company. As a result, the financial statement user can more easily compare the financial performance to the company's peers. Other than that, by analyzing how a company's financial results have changed over time, common size income statement help investors spot trends that a standard financial statement may not uncover. The common size percentage help to highlight any consistency in the numbers over time, whether those trends are positive or negative. Less changes in the percentage of the revenue as compared to the various expenses categories of a given period could be a sign that the business model, sales performance, or manufacturing costs are changing. From the table shown, it can be seen that the Pensonic company as a main company for the normal income statement and common size income statement for the year 2016 until 2020. This is the 5 years analysis. We can see that the sales revenue is a denominator. First of all, the cost of goods sold includes all of the costs and expenses directly related to the production of goods. From the table, we can see that the common size for the cost of goods sold are fluctuate starting from 2016 until 2020. As in 2016, the common size for the COGS is equal to 18.03%, while it start to decrease in 2017 and increase from the year 2018, 19, and 20. Next is the gross income. It is the revenue from all sources minus the firm cost of goods sold. In the common size, the gross income will be divided with the sales or revenue. There is a fluctuation percent in the gross income over revenue. Starting from the 2016 until 2017, there is an increment, while in 2018, it starts to reduce until 2020. For the SGA expenses, non-operating income and net income also show a fluctuation percent from the year 2016 until 2020. For SGA expenses, the lowest percent from sales or revenue is in 2016, while the highest in 2017. The percent of non-operating expenses income over sales revenue is equal to 4.29% as the highest in 2020 and 0.45% as the lowest percent in 2018. The last one is the net income. The highest is in 2016, while the lowest is in 2018 with a negative percent. Okay, let's move to the next slide. From the table given, it shows the common and normal income statement for the main and competitor company for the year 2020. Toshiba company is our competitor's company. This way could help investors to compare the financial performance of the Pensonic and Toshiba companies. For the cost of goods sold, the Pensonic company has the higher percent with 83.44% compared to Toshiba with 72.77%. Toshiba company has a higher percent of gross profit and SGA expenses over sales or revenue compared to Pensonic company with 27.23% and 16.56% respectively. While for the SGA expenses, Toshiba company has a higher percent with 23.02% compared to the Pensonic company with 18.48%. For the non-operating expenses and net income, the Pensonic company has a higher percent compared to Toshiba company. It is because the Toshiba company has negative percent for the non-operating expenses and expenses or income and net income with a negative 3.50% and negative 2.97% respectively. Okay, I think that's all from me. Thank you.
I will explain on the financial ratio. The first ratio is profitability ratio. Profitability ratio consists of return on asset ratio, return on equity ratio, and net profit margin ratio. For the return on asset ratio, the ratio is decreased from 2016 to 2018 and increased in 2019 and 2020. The higher the ratio, the better. Hence, Pensonic good in using its asset to generate earnings for these previous 2 years, which are on 2019 and 2020. The next ratio is return on equity ratio. The data shows that the return on equity ratio for Pensonic is decreased from 2016 to 2018 but improved in 2019 and 2020. It can be concluded that for the year 2019 and 2020, Pensonic is more efficient in generating income and growth from its equity compared to previous year, because the higher the ratio means company more efficient in handling the money that shareholders have contributed to it. The last ratio for profitability ratio is net profit margin ratio. It shows that the net profit margin ratio for Pensonic is decreasing from 2016 to 2018, but improved in 2019 and 2020. The higher the net profit margin ratio, the more efficient a company at converting sales into actual profit. For the year 2019 and 2020, it can be concluded that Pensonic is more efficient at converting sales into actual profit compared to 2018. Next, we proceed to liquidity ratio. The liquidity ratio consists of quick ratio and current ratio. For the quick ratio, the higher the ratio, the better a company's liquidity and financial health. The data shows that in 2016 to 2018, Pensonic having struggled in paying debts. However, for both 2019 and 2020, the ratio increased, and it indicates that the performance of Pensonic for quick ratio is improved and they are able to satisfy their current liabilities with its most liquid assets for that particular years. The next one is current ratio. The higher the current ratio, the better. It shows that the current ratio for Pensonic is quietly stable from year to year. The data also shows that the ratio is above 1.0, which indicates that the company's debt due in a year or less is lesser than its asset. In short, Pensonic able to pay its short-term obligations on time from the year 2016 to 2020.
I will explain about leverage ratio for Pensonic. And under leverage ratio, we have long-term debt to equity and total debt to asset. So for the long-term debt to equity, in 2017, the long-term debt to equity ratio is decreased from previous year. But start from 2018 until 2020, it increased rapidly. So it shows that the higher ratio of long-term debt to equity ratio for Pensonic prove that their company taking on more debts. So I will move to total debt to asset. The total debt to asset ratio is decreased in 2017, but it has increment in 2018 and start to decrease in 2019 until 2020. So it indicates that Pensonic total debt to asset ratio are not stable in the first 3 years and start to decrease their ratio until 2020. And it proved that Pensonic are unstable financial because the lower the ratio, the lower the degree of leverage and the lower the risk of investing in that company. Next is activity ratio. First is total asset turnover. So in 2016 until 2020, the total asset turnover are decreased from year to year. The total asset turnover is decreased in 2020. So from the comparing of the years, the total asset turnover for Pensonic are the most efficient for the company in using its asset to generate their revenue compared than the other year. So next, for the fixed asset turnover, in 2016, the fixed asset ratio are decreased from 2017 until 2020. From the data, 2016 has the highest fixed asset turnover ratio out of the 4 years. It indicates it's using its fixed asset efficiently to generate sales. So we move to inventory turnover. In 2020, high inventory turnover can indicate that Pensonic are selling their product in a timely manner, which typically means that sales are good in a given period. I will proceed with other two market ratio, which is price to earning and the market to book value. Price to earning, from the data it can be concluded that the ratio is increased for the year 2020 and the investors are expecting high growth rate in the future after their company facing hard time in 2018 and 2019. So next is market to book value. The market to book value increased in 2017 compared to 2016. A high ratio is desired by value managers who understand it to suggest that the company is a value stock that is trading at a discount to its book value in the market. However, from 2018 to 2020, the value was declined year by year. That's all from me. I will move to the next presenter. Thank you.
The next ratio in market ratio is earning per share ratio. The higher a company's EPS, the more profitable it is considered to be. It shows that the ratio is decreased from 2016 to 2019 and increased in 2020. In 2020, it indicates greater value and investor will pay more for a company's shares if they think the company has higher profits relative to its share price. The next one is dividend per share ratio. A consistent increase in dividend per share over time also can give investors confidence that the company's management believe that its earning growth can be sustained. In 2016, the dividend per share ratio is efficient and higher and start to decrease in 2017 and 2018. In 2019 and 2020, it stated zero of dividend per share, which means in that year, the company are risky because investors has lack of confidence to believe of their company performance to be invested. The last one for market ratio is dividend yield ratio. The dividend yield ratio is the return to shareholders. It can be concluded that from the year 2016 to 2018, the dividend is increased, but no dividend received by the shareholders for the year 2019 and 2020 due to decrease in company earning affected by the COVID-19 pandemic. That's all. Thank you.
Overall, from this assignment, we have analyzed that both Pensonic and Toshiba company has their own strengths and weaknesses. The Pensonic and Toshiba company has a good financial performance and worth to be invested by the investors. It is proved from the common size of financial statement analysis for the year 2020. Toshiba company has a great common size of balance sheet as it shows that the company has a lower debt and higher retained earning compared to Pensonic company. Other than that, the Pensonic company has a good common size income statement as the company has a positive net income while the Toshiba company has incurred loss. So, we believe that both companies worth to be invested, and by the analysis, it shows a good sign for investors to invest with them. That's all from us. Thank you.